Once again, we saw gains in the United States stock market. Today we were led higher by a lot of those technology and work from home stocks like DocuSign and Zoom. And so we did have another all-time high on the NASDAQ composite. We did see a little bit of a sell-off in the small caps and perhaps a little bit of a kind of a hanging man formation or maybe a hammer candle on the Dow Jones Industrial Average, depending upon your perspective there. But one thing that I'll stress is that it was a very similar day to what we experienced on Tuesday, where the vast majority of stocks actually closed lower on today's session, despite seeing most of the indices closing higher. So the internals and the market breadth have certainly left a lot to be desired through this record run that we've seen this week. So we'll take a look at all that, see what it means for our posture, then get into our trade application example, where I wanted to focus on another bearish trade from the healthcare space, similar to what I did on Tuesday. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 20th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, check out our description area, and sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we're also on Facebook. Feel free to check our group out at the web address embedded in the logo in front of you. All right, let's jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. For those of you that are premium members following along at home, this particular chart setup is just going to give us a kind of a quad grid or a 4 grid on the 4 major U.S. equity indices here, and give us a general sense of whether we have a bullish or bearish posture using that market forecast technical indicator, which are those 3 colored lines you see below each of those charts there. Now, to make it easy for you, the background color of the chart will allow you to visually see whether we have a bullish or bearish posture. And as you can see at this moment in time, all 4 of our charts have a green background color chart. In other words, we have strongly bullish postures across the board for these 4 different charts at this moment in time. And you can see in all 4 of the charts cases, the green line, which determines that posture on the market forecast, is in what we call the upper reversal zone. In other words, above 80 with its reading. The NASDAQ is at about 95, as is the S&P 500. Dow Jones Industrial Average a little bit lower at 86, and the same thing for the Russell 2000 at 86. You can see the Russell 2000 is in jeopardy of losing its bullish posture here if they can't start reversing things a bit higher here within the next week or so. Same thing could be said with the Dow Jones. Notice how both of those green lines are trending lower and are starting to threaten the 80th percentile, and if they cross below 80 on any given day in the coming week, their posture would go back to weakly bearish at that point. But we're getting ahead of ourselves there. For all we know, maybe we've got nothing but blue sky in front of us, and perhaps the entire market will just keep on winding its way higher. Now, in the intro, I mentioned that we had a peculiar circumstance once again in terms of market breadth. And I pointed this out in Tuesday's video as well, but just to kind of hammer that point home again, once again here, you'll notice that I'm on the Market Watch Visualize area of the Thinkorswim platform, and I've pulled up the S&P 500 as the index of choice. And you can see here that of the 500 companies on the S&P 500, 348 of them declined today. Only 151 of them advanced today. That's quite remarkable, and it's basically the same story as what I mentioned with you on Tuesday, which is this is a market that is being led higher by the dominant technology-oriented mega caps out there. Think about your Apples and your Microsofts and your Facebooks and your Googles. I saw Google had a very nice day today, which we appreciate since we do have an open trade going on Google right now, a bullish trade. So good to see that one working. But it's all those types of stocks and the ones that I mentioned as well before in the intro. Your kind of smaller companies, these days are not all that small, but kind of lesser known companies, I guess would be a better way to phrase it. Zoom and DocuSign, both of those stocks surged once again today. They're kind of the epitome of the work from home mindset there. So that particular theme does seem to continue to work. And if you're in other areas of the market, you're probably having less success. But there's patches of strength out there. Some of you might have seen on Twitter today that I was congratulating the classmates that attend my top-down trend trading class, because today was what we call double day, and that basically means that we doubled our money in Lululemon. Now, Lululemon itself is not necessarily a tech giant per se, but it is kind of one of those NASDAQ-oriented companies out there. And it's kind of new economy with all that yoga gear and everything. So anyway, we have had some success in a few of the consumer discretionary stocks like Lululemon as well. But for the most part, I would call this a tech rally that we've been experiencing here more recently. While I'm over here on the internet, I should also say thank you to those of you that clicked like for me. Last time around when I did the video, 113 of you did that. Remember, my goal is to get up and over 100, so we were able to achieve that once again, so keep up the great work there. If you want one of those full-length videos, all you have to do is click like. On the other hand, if you want more of an abbreviated video, then don't click like. And then if it's less than 100 likes, then I'll do a shorter video that time around. Also, wanted to mention that we had a great session today in my question and answer session. For those of you that are premium members, you're welcome to check out the recording. WebEx sent it back to me a little bit late today, but I did just get it posted here about a half an hour ago. So that is available for you to check out in case you were busy during that class earlier today. But we had excellent discussion about stocks like American Water, Bank of America, Alnylam Pharmaceuticals, Chewy, Realty Income, British Tobacco, Automatic Data Processing, and the German ETF. So if you're interested in those topics, you can see I've got them time-stamped here so you can fast forward directly to them. Again, that is for our premium members here at Market Scholars. So back on track here with our charts. The key takeaway on chart 4B is that we continue to retain those bullish postures for now, but there is a legitimate chance that at some point early next week, we might very well end up seeing weekly bearish postures on the Dow Jones and the Russell 2000. You can see today the Dow Jones did close near the highs of its session. This particular candle formation can be deemed a hanging man candle or a hammer candle. And how you determine which it is whether you think it's at support or resistance. If we're at a resistance area, that would be a hanging man, and it would be considered bearish, perhaps. We can't confirm it until the next day. On the other hand, if you believe that that type of candle exists at a support level, then perhaps you're going to view it bullishly. And I could actually kind of make the case for either one of those, quite frankly, because yes, we're rolling over a bit here from a bearish perspective with some of that horizontal resistance up there. On the other hand, you can see that exactly where this Dow Jones chart is forming that particular candle happens to be exactly at this old resistance area back on June 8th. So it was good that we broke down below that area today, but rallied back and actually closed higher on the session near the highs of the day. That could perhaps be known as a support bounce there, with the idea that old resistance becomes new support. So we'll have to keep our eyes on the situation in coming sessions to try to determine whether we're at resistance or support. What we can say with the NASDAQ Composite is that with its all-time high here, it was up over 1% today. This is still clearly in an uptrend here, so there's no debating on whether we're bullish or bearish with the NASDAQ. That seems to be the leading area of the market here currently. All right, let's go ahead and take a look at another chart. In this case, let's do the 3 green arrows. And as you can see here, we only have one of these 4 charts that retains its 3 green arrow status. For those of you that are premium members following along at home, this is chart 4D. And you can see the only stock or the only chart that retains that 3 green arrow status is the NASDAQ, naturally. With it hitting all-time highs today, it makes sense that it would be considered strong enough to retain that 3 green arrow status. The other charts have lost their status. A couple of them lost it just yesterday, and that was the S&P 500 lost it yesterday because it put in a red arrow on the MACD histogram. Same thing happened there with the Dow Jones Industrial Average. So it's telling us that we have a little bit of a loss of momentum when we're looking at that moving average convergence divergence there. With the Russell 2000, we actually got it 2 days ago, where we kind of fell out of bed in that particular case. So right now, we've only got 1 out of 4 charts here that has kind of those 3 green arrows with the 3 separate technical indicators lighting up all at the same time, despite the market forecast posture being bullish on all 4 of these. So that would give us a little bit more insight that indeed the NASDAQ composite appears to be the leadership group of this market currently. In terms of our longer term view now, let's look at the 1040 crossover. Now we do have one more day in this week. Always helpful to remind you of that because these are longer term charts that we're looking at here with chart 4C. These are 3-year weekly candle charts, so they don't actually get set in stone until Friday afternoon when that week's candle is closed up. But at this point, I don't think we'll see any major waves there. All of these charts currently have bullish 1040 crossovers, in other words, golden crosses, which are generally viewed as positive for those of you that want to be bullish on the markets. Now, again, you do have the ability to distinguish between charts, and you can see here that the NASDAQ Composite and the S&P 500 do look quite a bit better than the Dow Jones and the Russell 2000, despite all of them having that more bullish crossover at this current time. Let's now do a little bit of 12 grid analysis. And we'll start with the asset class 12 grid, which is chart 5A. All right, so as we pull this up here, you can see we've got a mixed bag in terms of which charts are leading and which ones are lagging. Naturally, the pink or red charts are the ones that are considered bearish with their posture currently. And the green ones are the bullish charts, according to the market forecast intermediate term line. Now, when we look at the bearish charts, one thing that catches my eye is that TLT and UUP, so both of those charts on the left-hand side there, are darker shade of pink, telling us that we have strongly bearish intermediate postures on those. And that seems to make sense in my head as well, just kind of visually eyeballing the other charts, because gold, real estate, and the 10-year U.S. Treasury yield also have pink charts, but they're light pink in their background, not dark pink. And you can see that in all 3 of those cases, right here with the real estate, right here with the treasury yields, and right here with gold, prices are above rising 30-day moving averages. So while their posture from a market forecast technical indicator perspective might be slightly bearish, the path of least resistance continues to be to the upside. I would say that is particularly the case with gold, as this has been an epic move for gold here more recently, and we pushed up and off of that rising 30-day moving average here more recently. But we've come a long way with gold, and this is one that we've been behind in these videos for months at this point. So I will just remind you that stocks and, in this case, commodities don't go straight up. I suppose maybe some Tesla shareholders would disagree with me on that point. But the point that I'm trying to make is there needs to be consolidation along the way for healthy advances. And so if we do run into a little bit of turbulence here on gold, don't necessarily despair about that. Look for opportunities when it presents itself if it appears like it's going to start stabilizing. Because right now we do have lower highs on the gold chart, and that will, of course, lead over to some of those gold mining stocks as well. Remember, we currently have a position going on GDXJ in this presentation. And let me see if I can go directly to that. GDXJ, where is it? There it is. This one actually expires tomorrow. We're in great shape on it. We sold the 42. I'm sorry, sold the 43 put in August. We bought the 42 put, so we did a bull put spread there, with it trading at basically $59 right now. Unless it plunges below 43 tomorrow, which I would not anticipate whatsoever, we should be able to milk max gains on that particular trade. We also ended up closing down our sleep number trade here today. So wanted to remind you of that as well. So sleep number, you can see up here, we closed that trade down at 265, and I did send that out via Telegram. Remember, with that particular trade, it's a little bit important for you to maintain it, because that was a long call spread. And right now, sleep number is trading directly between our strikes. We ended up making 100% return on that particular trade because we bought it for $1.30 and we got out at $2.65. But if you didn't do anything with your trade, what's going to happen if you continue to hold that trade through the weekend, you will likely wake up on Monday morning and there's going to be a bunch of stock of sleep number in your account because it will have closed in the money. So on a trade like that, unlike our GDXJ position, which was a credit spread, there we don't need to do anything because both of the strikes are going to close out of the money. But when you're dealing with a debit spread like we did with sleep number, it is important for you to close those trades down. So again, I did send that out via Telegram earlier today for those of you that are premium members of Market Scholars. So right here I said I shut down our prior long call vertical on sleep number at 265. We originally purchased it for $1.30, so we cleared over 100% on it. Remember, with that one being in the money currently, someone would want to shut it down by tomorrow afternoon. Otherwise, they might get assigned on the long call portion of the spread if the stock stays above 45 tomorrow, which is highly likely. So anyway, remember, if you're a premium member of Market Scholars, you get access to our Telegram channel where you're going to get the trade alerts that David and I put in, not only for our trading rooms that you attend all week, but also for these market outlook videos. So that way you get that information sooner than just somebody who's watching the free version of the market outlook on YouTube. So another perk for those of you that are premium members in that case. Anyway, back on track with these charts here. We don't need to do anything with our gold junior, miners ETF position that we have, but I do want to point out that we have a lower high on gold. At this point, we have a pretty decent chance of putting in a higher low as well. So we're kind of coiling at this moment, and the good news is we're coiling above a rising 30-day moving average. So I think there is that chance that it breaks out to the upside, but obviously you're going to want to keep your eye on this situation because after going almost straight up for gold, it's kind of been sucking wind here in the last couple of weeks. So keep your eyes on that situation there. With the other charts that are green, we mostly have pretty robust charts that we're dealing with here. I would point out that EEM did have a little bit of slippage here today. We were down 0.32%. And I did notice that, like China, as one example, as being a key country within the emerging markets, is starting to struggle a little bit as well. Remember, you could look at China by looking at FXI here. And you can see that it is well off of its highs that it put in the first week of July. Whereas, of course, here in the United States, we just hit an all-time high yesterday. So there are a couple of areas like China that might be starting to pressure EEM just a little bit. Again, don't make too much of it. It still is a strongly bullish trend. It's just that it is now touching the 30-day moving average, whereas during this entire run here for the previous 3 months, we didn't touch it with the exception of that one day back there on May 22nd. Otherwise, all of these candles are above that rising moving average. So this is a little bit of a change of tone that we've had here with EEM touching that moving average. And we're going to want to keep our eye on it because that is an area where we could start seeing a little bit of a breakdown of support. The other areas, including the developed foreign stocks and the United States stock market, continue to be above their rising moving averages very nicely. And high yield bonds, once again, bounced today. I mentioned that chart specifically on Tuesday. We're getting a nice bounce up and off of that 30-day moving average. We did that once again today. So it's not up dramatically off of it, but it is good that it's trying to think about whether it wants to break down or not. And right now, it seems like those that are participating in the junk bond market would rather be buyers of those securities than sellers. So we'll keep our eye on that as well. All right, let's take a look at another 12 grid. In this case, we're going to take a look at the sectors, so U.S. sectors. Now, remember, this will be the market cap weighted version. And as you can see here, we've got a little bit of a mixed bag here as well. So it wasn't too long ago where I was mentioning that we had a clean sweep with the sectors in the United States. That is no longer the case. Now we can see that financials have a light pink background, as do energy stocks and utilities. And no surprise, all three of those sectors were down today on a day when the S&P 500 was up. Well, all goes back to what I mentioned before, which is technology and communications are rallying strongly, especially on a market cap weighted basis. So with technology, we were up 1.33% today. With communications, we were up 1.24% today. So remember, technology is where you're going to find Apple and Microsoft, and communications is where you're going to find Google and Facebook and a lot of those web names there. Both of those charts look like spitting images of one another. They're both consistent to the upside on the market cap weighted basis. On an equal weighted basis, there is a little bit more slippage out of technology. Not a lot, but it does seem to me that the communications area is maybe holding up a little bit better on an equal weight basis. Remember, we have a chart for that now as well. It's going to be chart 5R, the equal weight versions. And here you'll notice that the communications basically hit a new high just yesterday on an equal weight basis. Technology did pretty good today, right? They were up today, but notice this. Technology is well below where it was trading on August 5th. So if there's one takeaway from tonight's video that you want to be aware of, it's that it's not just technology itself is working right now. It's a very specific brand of technology that's working right now. It's the mega caps that are controlling the action on the market cap weighted indices, because we're actually not seeing a robust move in technology on an equal weight basis. Now, it's not terrible. It's not like we're breaking down in a big way either, but we're certainly not seeing the breakout type of performance that we're seeing on the market cap weighted version. So remember, there are different ways to look at these various charts. And remember, when I look at when I put together the sector selector, that would be this. I usually put this together on Friday nights for my students. This is on an equal weight basis. So we're looking basically at 1,000 stocks chopped up into 11 different sectors and looking at things on an equal weight basis, not on a market cap weighted basis. So the reason that I pretty much knew that technology was not holding up as well as communications from that perspective, I hadn't even looked at the 12 grid until just now, but the reason I knew it in my own head is because we've seen slippage in technology in the overall sector rankings here. And some people might be kind of scratching their head and thinking, well, how can that be? XLK looks great from a market cap weighted perspective, and that is true. But that is not what I'm using in this particular case. I'm trying to get a sense of whether the generals and the Army are participating in the march higher, or whether it's only the generals. And right now, in the technology world, you could get away with saying it is mostly the generals that are advancing their front, and the Army behind them is kind of just stalled out and taken camp. Whereas communications, it's holding up much better. Notice that communications has advanced 2 straight weeks. So more of those small and mid-cap kind of internet names, and even some of your cell phone companies like T-Mobile doing pretty well here recently, whereas we can't really make the same case for technologies. We'll see if that changes at all when I redo the rankings here tomorrow night, but that is something that you're going to want to consider as you go forward with your next best trade ideas as well. You'll also notice that utilities have kind of really fallen apart here in the last couple of weeks. They're the worst performer over that particular time period. And I also wanted to point out healthcare, because somewhat similar to technology, healthcare has kind of fallen out of bed here recently on an equal weight basis. Again, remember, Johnson & Johnson is probably the world's biggest publicly traded healthcare company, or at least it is here in the United States. So Johnson & Johnson is going to have much more influence on something like XLV, but it is not going to have as much influence on an equal weight version of it. So Johnson & Johnson hasn't really been breaking down here recently, but some of you might have caught on Twitter here just about a half an hour or so ago that I said, if you go through a bunch of healthcare charts, they are starting to feel really heavy. I mean, a lot of them. I was a bit surprised, because I had just made an assumption that healthcare is holding up fine because they had been holding up fine for really the last 4 or 5 months. But all of a sudden, if you start rattling through all of those healthcare stocks that make up the Market Scholars healthcare sector, remember those of you that are premium members would have access to that watch list, I would say that probably a good 40% of the individual healthcare names have charts that I would be concerned about if I owned them myself. So keep your eye on the healthcare space. It's feeling heavy. We'll see if it can ratchet back. But right now, this might be a little bit of a transition we're recognizing within the market itself. Now, you guys will remember that on Tuesday, I did a bearish trade on AbbVie within the healthcare space. And I had some bad luck on that front because I actually put the trade in before the market close on Tuesday, and lo and behold, there was some news report that came out after hours that actually helped that particular company and hurt Gilead Sciences. And of course, I would have had no advance notice of that. So I wish I would have waited to put that trade in the next day. But as I looked at that particular stock chart here today, so let me come back on over here to swing trading 1 grid. So this will be 3A here for those of you following along at home. And as we look at AbbVie, so ABBV, we put the trade in on this candle. I was thinking it was going to bounce down off of that falling moving average there, but then all of a sudden we got some random news story that Gilead's drug was likely not going to be approved by the FDA, and the competing drug over at AbbVie was going to benefit from that. So there was a bit of a gap up that took place there. But worth noting is that AbbVie looks terrible today, right? It's down almost 1% today and is bouncing down and away from that 30-day moving average there. So the trade might not be dead. It didn't maybe get off to the right foot for me, but the trade itself still looks sound in that perspective. The other thing I would point out is if we do pull up XLV in this case, so this is the healthcare ETF, the market cap weighted version of it. Notice that we have what's known as a bearish near-term divergence on the entire healthcare chart. Remember that bearish near-term divergence can be identified by looking for the peaks in the near-term line. So here's peak number 1 in the upper reversal zone. The second peak that comes in is slightly lower than the upper reversal zone. So in other words, lower highs on the near-term line down below. The candles associated with them are this candle right here and this candle right here. So price went up slightly. At the same time, the underlying indicator went down, and we have a bit of a divergence of thought there. So I don't want to make too much of it because keep in mind XLV is still above a rising moving average. But we are starting to see a little bit of turbulence there, some holes that are being punched into the thesis of a lot of those healthcare stocks. So let's go ahead and place another one of those trades, and some of you might have caught this already when I was sharing the Telegram. The trade has already been placed, and I sent that out to our premium members before the market closed so that they could evaluate it on their own prior to everybody else getting it for free later on in the night when the YouTube video comes out. So what I did was I bought a long put vertical spread on CVS, and I did the September monthly contracts, the 65 by 62.50, and I paid $1.20 out of my pocket for that. So remember, when you're doing one of those types of spreads, kind of your break even, if you want to think about it from that perspective, would be, in this case, $65 minus the $1.20 that I paid out of my pocket. That ends up being $63.80. So at this point, we are 8 cents to the good, because remember, this is going to be a bearish trade here. So we want this stock to go lower from now until the September expiration. Ideally, we'd love for the stock to close below 62.50. So at this point, we're a little bit in the good there. I actually was trying to get a bear call spread filled on this one within the last half of an hour, but the darn paper money platform would just not get me filled. So it wasn't my intended trade, but I didn't want to force the trade through at the same time. So instead, I kind of regrouped and did a different type of bearish trade, in this case a long put vertical, which is a debit spread, and it does require a directional move out of the stock. And you can see today was an important day because not only did we come down below that moving average, but we actually crossed below these two candles here on the 13th and 14th of August. So we're breaking down below some key support levels there. So what we're shooting for in this case is for the stock to come down to about right here, 62.50, between now and the September options expiration time period. And if we continue to get some bearishness coming through with healthcare stocks, because remember, CVS Caremark is now considered a healthcare stock. They used to be a consumer staple, but now with them buying out one of those big health insurers here, I think they bought Aetna, they switched their sectors. So CVS is a healthcare company, Walgreens is still a consumer staples company. So if we start seeing more and more some aggressive selling in some of those healthcare names, that could be a bearish indication there for a stock like CVS, as well as we're heading towards the election time period as well. Remember, there is a general philosophy out there that if the Democrats take control, that would be bad for the profit potential of healthcare-oriented companies. So if that kind of theory starts playing through a little bit more, we might start seeing a slippery slope on some of these healthcare names here. And with our trade on AbbVie and now our trade on CVS, we've got a couple of bearish trades there that are working on our behalf. Okay, so let's go ahead and wrap the video up for tonight. Remember, if you got value out of the video tonight and you want to see me do another full-length video the next time I do the video, which will be on Tuesday, I would encourage you to click like for me over on Twitter on this market outlook related tweet. If we get over 100, I'll do the full-length video. If we get under 100, I'll just do an abbreviated, probably 15-minute version of the video itself. So I kind of let that control in your hands as to whether you prefer the longer versions or the more abbreviated versions there. So anyway, I hope you got some value out of tonight's video. David should be back in action with you tomorrow night to wrap up the week as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.